Something doesn't add up in the UK housing market. House prices haven't collapsed, but affordability is sitting at its worst level in decades. Sales activity is slowing down, yet the supply of available homes still feels tight. Millions of homeowners are quietly approaching a financial cliff, one that hasn't fully registered in the banking system yet. To understand why this matters, you have to look at the broader picture. The UK housing market dictates consumer confidence, banking stability, and the momentum of the entire national economy. And today, all three are under strain. Interest rates, which sat near zero for years, have moved sharply higher. Mortgages that once hovered around 1 or 2% are now closer to 4, 5, or even 6%. That one shift alone changes everything, because housing isn't priced on total value, it's priced on monthly affordability. When borrowing costs rise that fast, the mathematical rules of affordability reset. The result is a state of agonizing friction instead of a rapid crash. This tension is the legacy of a decade of cheap money. After the 2008 financial crisis, central banks, including the Bank of England, kept interest rates near zero to support economic growth. That policy created a chain reaction. Cheap money meant low-cost mortgages, which drastically increased buyer demand. But the UK has long faced a structural housing shortage. Surging demand was left chasing a limited supply of homes, driving prices steadily higher. Then came the pandemic. Rates dropped further. Government incentives flooded the market, and the shift to remote work caused a massive spike in housing demand. Relentless growth was built on a temporary anomaly, cheap borrowing. Then inflation hit. To fight it, central banks raised rates, and the foundation of cheap money vanished practically overnight. Now here's the part most people are missing. The real impact of higher interest rates hasn't fully hit yet. Why? The answer lies in the mechanics of UK mortgages. A massive portion of homeowners are locked into fixed-rate deals, often lasting 2, 3, or 5 years. Millions of people are temporarily shielded, continuing to pay monthly costs based on the old rates. This delay creates a standoff. Sellers are refusing to cut their prices, new buyers can't afford the higher rates, and transaction volumes have plummeted. The current appearance of stability is an illusion. It is a ticking mortgage time bomb created by a delay in the system. As those fixed deals expire, monthly payments jump dramatically, often by hundreds of pounds more per month. This is already rippling through capital flows. Buy-to-let investors are facing shrinking profitability, forcing many to exit the market and dump their supply. For existing homeowners, refinancing is becoming a major financial event. As higher mortgage payments consume a larger share of the household budget, discretionary consumer spending inevitably shrinks. We have to separate the market symptoms. House prices are a historical metric. They tell you what has already happened. Financial stress tells you what might happen next. The primary risk today is a slow squeeze, a years-long process of drifting prices and constrained demand that creates prolonged stagnation. The long-term direction of the market depends on interest rates. If rates fall, the system could stabilize. But if inflation keeps rates structurally elevated, the pressure will extend. The UK housing market has entered a quiet, structural reset, marking the beginning of an era of permanent financial pressure.